The signal that matters is not moving across the surface of the ocean. It is moving quietly through spreadsheets, settlement systems, and balance sheets that almost no one reads. Aircraft carriers can be deployed, photographed, and withdrawn. Missile drills can be announced, televised, and explained away as exercises. These are the visible gestures of power, designed to be seen and interpreted. Sovereign debt behaves differently. It is heavy, inert, and slow. Large positions cannot be unwound quickly without consequences. When they move with speed, it is not theater. It is intent. That is why the most important geopolitical development of the past year did not occur in the Taiwan Strait. It occurred inside a technical release from the United States Treasury Department that most market participants barely glanced at before moving on. The document is the Treasury International Capital Report, a bureaucratic compilation of cross-border capital flows that rarely makes headlines. Yet buried inside its tables is a number that reframes the global order. As of October 2025, China's officially reported holdings of United States Treasury securities fell to $688 billion. In isolation, that figure appears large. In context, it represents a collapse. It is the lowest level of Chinese ownership since the aftermath of the global financial crisis in 2009. 16 years of financial integration have been unwound. Nearly half of China's peak position has been liquidated. This is not a portfolio adjustment. It is a structural exit. At the height of the so-called symbiotic phase of globalization in 2013, Beijing held more than $1.3 trillion in American sovereign debt. That arrangement formed the invisible backbone of the modern global economy. China recycled its trade surplus into United States Treasuries. Those purchases suppressed interest rates, funded American deficits, and enabled U.S. consumers to absorb an endless flow of inexpensive manufactured goods. Capital flowed east to west as debt, then west to east as consumption. The loop was stable precisely because it was slow. Breaking it would require time, patience, and a tolerance for losses. That is why the manner of China's exit matters more than the headline number itself. The most revealing detail is timing. China has been selling throughout a period when the American bond market was under historic pressure. Rising yields and volatile rate expectations pushed bond prices sharply lower during late 2024 and throughout 2025. In bond mathematics, price and yield move in opposite directions. Selling into that environment locks in losses. Large institutional holders do not voluntarily realize losses of that magnitude unless they are forced by circumstance or driven by strategy. China faces no acute liquidity crisis. Despite domestic stress in real estate and local government finance, it continues to run a substantial trade surplus. Cash is not the constraint, risk is. This is the first destabilizing truth. From Beijing's perspective, United States Treasury securities have ceased to function as reserves. They no longer represent stored value, they represent stored vulnerability. That perception did not emerge gradually through academic debate. It crystallized in a single moment that fundamentally altered how sovereign assets are understood. In February 2022, Western governments froze hundreds of billions of dollars belonging to the Russian central bank. These funds were legally owned, contractually settled, and held inside the international financial system. They were rendered inaccessible overnight through coordinated sanctions. The precedent was unmistakable. Sovereign reserves are only sovereign as long as the political environment allows them to be. China watched that episode with extreme attention. The conclusion was unavoidable. In any future confrontation involving Taiwan or regional sea lanes, dollar-denominated assets held under Western jurisdiction would not function as buffers. They would function as leverage points for an adversary. Under sanctions, they would effectively go to zero. From that moment forward, holding vast quantities of United States government debt stopped being prudent and started being dangerous. The decision to sell was therefore not reactive. It was preventative. Accepting a measured loss today was preferable to risking total immobilization tomorrow. The velocity of the recent decline reinforces this interpretation. Central banks typically distribute large sales quietly, minimizing market impact and avoiding attention. The recent data shows acceleration instead of discretion. Nearly $12 billion were shed in a single month. That pace signals urgency. Jurisdictional risk now outweighs market risk. Capital must be moved out of reach, even if doing so requires unfavorable pricing. In financial terms, this resembles a controlled demolition rather than a gradual rebalance. The implications extend far beyond China. For decades, the United States benefited from an external buyer base that was indifferent to yield. China purchased treasuries not because they were attractive investments, because they were the settlement asset of global trade. That buyer has turned into a seller. The demand structure underpinning the bond market is therefore changing. In a system defined by scale, the loss of a marginal buyer is survivable. The loss of a structural buyer is not. When hundreds of billions of dollars of supply are introduced without an equivalent commercial buyer to absorb them, basic market logic dictates higher yields and lower prices. Yet the collapse has not fully materialized. Yields have risen, but not catastrophically. This apparent stability creates a second paradox. If market forces were operating without intervention, rates would already reflect the scale of China's exit, the fact that they do not indicate substitution. Other entities are absorbing the supply. The question of who is stepping in and why will define the next phase of the global financial system. The answer is not found in market optimism or improved fundamentals. It is found in coordination, obligation, and pressure. This is why the $688 billion figure functions as more than a data point. It is a signal that the financial architecture built over 4 decades is being stress-tested from within. China is not merely reducing exposure. It is preparing for a world in which financial integration is a liability rather than a safeguard. Sovereign debt, once the quiet foundation of globalization, has become an active front in strategic planning. The exit has begun. The consequences will not be immediate, but they will be cumulative. And once this process reaches its logical conclusion, there will be no simple mechanism to reverse it. To understand why China's drawdown carries systemic weight, it is necessary to reconstruct how United States Treasury debt became the central pillar of the post-Cold War financial order. This was not an accident of convenience. It was the outcome of deliberate structural choices made after the 1970s, when the dollar was severed from gold and re-anchored instead to trade, energy, and security. From that moment forward, USS sovereign debt evolved from a domestic funding instrument into the primary reserve asset of the global system. It was liquid, deep, and backed not only by taxation, but by military reach and institutional trust. China entered this system gradually. After joining the World Trade Organization in 2001, its export engine accelerated with unprecedented speed. The resulting trade surpluses generated vast quantities of dollar inflows. Those dollars had to be placed somewhere. United States Treasuries offered scale and safety. They also served a political function. By financing American deficits, China reinforced the consumption cycle that absorbed its exports. This arrangement, sometimes described as Chimerica, bound the two economies together through debt rather than treaty. Stability depended on mutual restraint. Neither side could exit quickly without destabilizing itself. For more than a decade, this structure worked. American interest rates remained low, asset prices rose, global growth appeared synchronized. Under the surface, however, the system accumulated fragilities. The United States increasingly relied on deficit spending as a permanent feature rather than a counter-cyclical tool. China accumulated reserves far in excess of any plausible stabilization need. Both sides assumed continuity. What changed was not the math, but the meaning of the assets themselves. The first fracture appeared during the global financial crisis of 2008. Central banks expanded their balance sheets dramatically, demonstrating that monetary rules could be suspended under stress. China responded by doubling down on treasuries, viewing them as the safest available option in a disorderly world. Yet this episode planted an early seed of doubt. If money could be created at will, then reserves held in that money were subject to dilution. Inflation was suppressed at the time, but the mechanism was exposed. The second fracture emerged through sanctions policy. After 2014, following Russia's annexation of Crimea, financial sanctions became a routine instrument of statecraft. Payment systems, correspondent banking, and reserve custody were increasingly weaponized. These measures were targeted and limited, but they revealed a hierarchy embedded in the financial system. Access was conditional. Ownership did not guarantee control. For a rising power with geopolitical ambitions, that realization mattered. The decisive rupture arrived in 2022. The freezing of Russian central bank reserves transformed a theoretical risk into an operational fact. This was not a commercial dispute. It was a political decision executed through financial infrastructure. Assets that had been treated as untouchable were rendered inert. The implication was universal. Any state outside the Western alliance could face similar measures under sufficient provocation. Trust in the neutrality of reserve assets was permanently altered. China's strategic culture is deeply influenced by historical memory. Periods of weakness are associated with external dependency and internal fragmentation. Periods of strength are associated with self-sufficiency and control over material inputs. From that perspective, holding large quantities of foreign sovereign debt inside an adversary's legal system appears reckless. The reassessment was not ideological, it was operational. Reserves are meant to ensure continuity under stress. If they fail under the most critical scenario, they are misallocated. This context explains why the liquidation accelerated precisely when market conditions were unfavorable. Traditional asset management logic prioritizes price optimization. Strategic logic prioritizes jurisdictional safety. Once the decision was made that treasuries no longer fulfilled their primary function, timing became secondary. The goal shifted from maximizing value to minimizing exposure. Losses were accepted as the cost of repositioning. At the same time, the United States' own fiscal trajectory reduced the attractiveness of its debt. Persistent deficits exceeding $1 trillion annually became normalized. Debt servicing costs rose alongside interest rates. Political polarization complicated fiscal reform. From an external creditor's viewpoint, the risk profile deteriorated even before sanctions considerations were applied. A higher supply of debt required higher demand to maintain price stability. If demand became political rather than commercial, the equilibrium weakened. China's reduction must also be understood relative to alternatives. There is no true replacement for the U.S. Treasury market in terms of size and liquidity. European sovereign debt is fragmented. Japanese debt is domestically absorbed. Emerging market debt lacks scale and stability. This means China's exit does not imply a simple rotation into another financial asset. It implies a partial exit from the financial reserve paradigm altogether. That distinction is critical. The decision is not about reallocating within markets. It is about redefining what constitutes a reserve. Historically, reserve systems persist until they fail abruptly. The British pound dominated global reserves well into the 20th century, despite the relative decline of the British economy. The transition to the dollar accelerated only after war and financial exhaustion forced a reset. In each case, the process was gradual until it was not. Signals accumulated quietly before crystallizing under pressure. China's drawdown functions as such a signal. It does not trigger collapse by itself, but it reveals shifting expectations among the largest actors. This context reframes the $688 billion figure. It is not simply the residue of past accumulation. It is a deliberately maintained minimum, a balance between exiting risk and avoiding disruption. The remaining holdings are still substantial, but they are shrinking. Each reduction reduces entanglement. Each sale converts a claim into optionality. The underlying message is not about confrontation tomorrow, but about preparedness over time. The system that treated sovereign debt as neutral infrastructure is giving way to a system that treats it as strategic terrain. Once that shift occurs, behavior follows. China's actions reflect an assessment that the era of unquestioned financial integration is ending. The next question is how the system adapts to that withdrawal and who absorbs the strain in the interim. The pattern becomes visible only when the buyer side of the Treasury market is examined alongside the seller. China's exit did not produce an immediate collapse in yields, not because the pressure was absent, but because it was absorbed elsewhere. The Treasury International Capital data reveals that as China's holdings declined, other jurisdictions increased their exposure at an unusual pace. This substitution is not random. It is structural, coordinated, and political. The market did not replace an economic buyer with another economic buyer. It replaced one strategic actor with a coalition operating under obligation. The most striking shift appears in the United Kingdom. By late 2025, reported British holdings of United States Treasuries exceeded $750 billion, placing the United Kingdom alongside China as one of the largest foreign creditors to the United States. This outcome defies conventional trade logic. The British economy is far smaller than China's. It does not run persistent trade surpluses with the United States. It does not generate excess dollar inflows that require recycling at scale. The capital used to purchase this debt is therefore not surplus capital. It is leveraged capital. This distinction matters. China accumulated treasuries as a byproduct of production. It sold goods, earned dollars, and reinvested those dollars into debt instruments. The United Kingdom is purchasing treasuries through its financial sector using balance sheet expansion, leverage, and intermediated flows. In effect, it is acting as a shock absorber for the American bond market, not because the trade is attractive, but because stability demands it. This is not yield-seeking behavior. It is system maintenance. Belgium presents a similar but more opaque signal. On paper, Belgian holdings surged into the hundreds of billions. In practice, Belgium functions as a custodial hub rather than a discretionary investor. Its role as host to major international securities depositories means that positions recorded there often belong to third parties seeking anonymity. When holdings spike through this channel precisely as China sells, the implication is masking. Buyers are present, but they prefer not to be visible. That preference itself is revealing. Together, these shifts indicate a coordinated effort within the Western alliance to prevent disorder in the Treasury market. The motivation is straightforward. The United States sovereign debt is not merely a funding instrument, it is the collateral backbone of the global financial system. It underpins repo markets, bank balance sheets, and derivative pricing. A disorderly sell-off would propagate through funding channels rapidly. Preventing that outcome becomes a collective imperative for those most exposed to the system. This is the mechanism of financial conscription. Allies are not instructed publicly to purchase treasuries. They are confronted with a binary choice. Absorb the supply or accept systemic instability that would overwhelm their own economies. The pressure is implicit rather than explicit. It operates through shared institutions, currency swap lines, and regulatory expectations. Participation is framed as cooperation. Refusal would be interpreted as defection. The consequences of this arrangement are asymmetrical. China's selling converts a financial claim into liquid capital that can be redeployed. The Allies' buying converts liquid capital into long-duration exposure at a moment of elevated fiscal risk. The balance sheets of these states stretch to accommodate the system's needs. Their domestic economies do not necessarily benefit. Liquidity that could fund infrastructure, energy transition, or industrial renewal is diverted into refinancing American deficits. Capacity is the limiting factor. China's ability to accumulate debt rested on its role as the manufacturing engine of the world. It generated real goods and earned real surpluses. The United Kingdom and much of Europe do not possess comparable surplus-generating capacity. Their purchases rely on leverage and financial intermediation. This makes their support conditional and fragile. When domestic stress emerges, the political tolerance for sustaining foreign debt holdings diminishes rapidly. This fragility has already been demonstrated. In 2022, stress in British pension funds triggered forced selling of long-dated government bonds, requiring central bank intervention. That episode illustrated how quickly leverage structures can unwind when yields move against them. Applying similar leverage to foreign sovereign debt compounds the risk. The buyer of last resort becomes vulnerable to its own exposure. From China's perspective, this dynamic is advantageous. Each dollar of treasuries sold must be absorbed by someone. Each absorption consumes balance sheet capacity elsewhere. Over time, the cumulative effect weakens the financial resilience of the alliance. This is attrition, not shock. The objective is not to trigger immediate collapse, but to increase the system's sensitivity to future stress. At the same time, the composition of the Treasury market is changing. It is shifting from a market dominated by commercial logic to one dominated by political necessity. Political buyers behave differently. They are more sensitive to domestic backlash, currency instability, and electoral cycles. Their commitment is contingent. When conditions change, they may exit abruptly. Markets price stability based on expectations of continuous demand. When that demand is conditional, volatility increases. The pattern therefore reveals a transition. United States Treasuries are evolving from a global reserve asset into a block-based reserve asset. The buyer pool narrows, issuance expands. The system becomes more brittle. China's withdrawal exposes this reality rather than causing it. The apparent calm rests on substitution, not resolution. As long as substitution continues, yields remain contained. When substitution falters, adjustment accelerates. This is the real mechanism underlying the data. China is not simply reallocating reserves. It is exploiting the structural dependency of the system on continuous foreign absorption. By selling steadily, it forces others to reveal their limits. The Treasury market becomes a testing ground for alliance cohesion. Financial stability becomes inseparable from political alignment. That is the pattern now in motion, and it is not easily reversed. The logic now unfolding is not unprecedented. It mirrors earlier moments in financial history when reserve assets transitioned from instruments of efficiency to instruments of coercion. What distinguishes the current phase is speed, scale, and technological reach. Modern financial infrastructure allows political decisions to propagate through markets almost instantly. Capital that once moved slowly across borders can now be immobilized with a legal notice and a software update. This reality reshapes how states perceive safety, liquidity, and sovereignty. A modern parallel can be found in the late stages of the British imperial system. By the early 20th century, sterling remained the world's primary reserve currency despite Britain's declining industrial dominance. London's financial markets were deep and trusted, but the underlying economic base was eroding. To maintain stability, Britain relied increasingly on cooperation from allies and colonies, drawing capital inward to support external commitments. The system persisted until the strains of global conflict exhausted it. The transition to the dollar was gradual, then sudden. The reserve asset did not fail because it was poorly designed. It failed because the political and economic context changed faster than the system could adapt. Today's dollar-based order faces a similar tension. The United States retains unmatched financial depth and military power, but its fiscal position is increasingly dependent on external financing. Persistent deficits are normalized. Debt issuance expands to meet political demands. Under stable conditions, this is manageable. Under strategic competition, it becomes a vulnerability. The use of sanctions accelerates this shift by transforming financial infrastructure into a weapon rather than a neutral utility. China's response aligns with how other actors have adapted when confronted with comparable risks. After sanctions, pressure intensified in the 2010s. Russia reduced its exposure to U.S. Treasuries dramatically and increased its holdings of gold. Iran developed alternative settlement mechanisms for energy trade. Smaller states explored bilateral currency arrangements to reduce reliance on dollar clearing. None of these measures dismantled the system. They created redundancy. Redundancy is costly in peacetime and invaluable under stress. What makes China's actions distinct is scale. No other country possesses both the incentive and the capacity to exit in size. Its remaining holdings still represent a substantial position, but the direction of travel matters more than the endpoint. Each sale reinforces a behavioral signal to others. Reserve managers observe not only yields but intentions. When the second largest economy treats treasuries as expendable, the perception of permanence erodes. This perception feeds into private markets as well. Institutional investors price sovereign risk based on political as well as economic variables. If geopolitical alignment becomes a prerequisite for reserve status, neutrality loses value. Capital begins to fragment along alliance lines. This fragmentation is already visible in trade settlement data, commodity pricing arrangements, and cross-border payment initiatives. The system does not break, it regionalizes. In this environment, traditional portfolio assumptions weaken. Bonds have historically served as a hedge against equity volatility. That relationship relies on confidence in the issuer's fiscal capacity and monetary credibility. When debt issuance is driven by political necessity and absorbed by obligated buyers, price discovery becomes distorted. Volatility is suppressed until it is not. The adjustment, when it arrives, tends to be nonlinear. Central banks are aware of this risk. Their dilemma is structural. Allow yields to rise and risk financial instability, or intervene and risk currency debasement. Intervention stabilizes markets in the short term, but reinforces the incentive for reserve holders to exit over time. Each episode of intervention confirms that debt sustainability depends on monetary expansion. For states seeking insulation from inflation and sanctions, this confirmation accelerates diversification. The modern parallel, therefore, extends beyond sovereign behavior to institutional response. During the 2008 crisis, central banks acted as buyers of last resort to stabilize markets. That role expanded during the pandemic. It is now embedded in expectations. Markets assume that disorder will be contained. This assumption reduces immediate risk-taking costs, but it increases long-term fragility. When support becomes permanent, withdrawal becomes destabilizing. China's strategy exploits this asymmetry. By exiting gradually, it avoids triggering immediate intervention. By exiting persistently, it ensures that intervention becomes more likely over time. The longer the process continues, the greater the eventual reliance on central bank balance sheets. That reliance translates into currency risk for those who remain invested. This is not a speculative view. It is a mechanical outcome of supply and demand. Modern parallels can also be drawn from commodity markets. When strategic buyers accumulate physical resources rather than paper claims, prices respond differently. Storage replaces yield as the cost of security. Returns are measured in availability rather than income. This shift reflects a broader redefinition of value. In an environment where access can be restricted, ownership regains primacy. The global system is therefore entering a phase where financial efficiency competes with strategic resilience. The two are not easily reconciled. Efficiency favors concentration and scale. Resilience favors diversification and redundancy. China's actions indicate a preference for the latter. That preference does not require immediate confrontation to be rational. It requires only the recognition that future scenarios may invalidate current assumptions. For market participants, the parallel is instructive. Periods of apparent calm often coincide with structural transition. Stability maintained through coordination can persist longer than expected, but it does not resolve underlying imbalances. When alignment fractures or capacity limits are reached, adjustments accelerate. History suggests that reserve transitions are rarely smooth. They are punctuated by crises that reprice risk abruptly. The present moment reflects the middle phase of such a transition. The incumbent system continues to function. Alternatives are incomplete. Behavior changes incrementally. Data points accumulate. The $688 billion figure is one such data point. It signals not collapse, but intent. The modern parallel suggests that intent precedes action by years, not months. Those who ignore it because markets appear stable misunderstand the nature of systemic change. This is how financial orders evolve, not through sudden abandonment, but through persistent reallocation. Not through public declarations, but through balance sheet decisions. China's exit from U.S. Treasuries fits this pattern precisely. It is a contemporary expression of an old dynamic, unfolding under modern conditions with modern tools. When systems approach their limits, they rarely announce it openly. They reveal themselves through behavior that appears irrational under old assumptions, but coherent under new ones. China's sustained reduction of United States Treasury holdings is one such behavior. Interpreted through the lens of yield, it looks inefficient. Interpreted through the lens of survival, it is methodical. The distinction defines the era now unfolding. For 40 years, the global financial system trained participants to equate safety with liquidity and return with stability. Sovereign bonds, particularly those issued by the United States, were treated as risk-free not because risk was absent, but because it was invisible. Political continuity, institutional trust, and geopolitical dominance masked fragility. The moment those conditions began to erode, the meaning of safety changed. What was once considered inert ballast became active exposure. China's actions reflect this recalibration. By converting financial claims into optionality, it reduces dependence on external permission structures. The remaining holdings are not an endorsement of the system's permanence. They are a buffer against disorder during transition. The direction matters more than the destination. Each reduction is a signal that the old equilibrium no longer governs decision-making. The broader implication is not that the dollar system collapses tomorrow. It is that its operating logic shifts. Reserve assets function best when they are boring. They fail when they become strategic. Once reserve holdings are evaluated based on sanction risk and political alignment, neutrality disappears. Capital begins to cluster. The system fragments. This process does not require confrontation to proceed. It requires only mistrust. For the United States, this presents a dilemma without an easy resolution. Maintaining global demand for its debt requires confidence that assets will remain accessible under all but the most extreme circumstances. Weaponizing finance undermines that confidence even as it delivers short-term leverage. Fiscal discipline could offset some of this erosion, but political incentives push in the opposite direction. Deficits are easier to expand than to constrain. Central bank intervention can stabilize markets temporarily, but it reinforces the perception that debt sustainability depends on monetary accommodation. For allies, the costs are more immediate. Acting as residual buyers absorbs risk without generating corresponding economic benefit. Balance sheets stretch. Domestic priorities compete with external obligations. Political tolerance for such arrangements is finite. When stress emerges, these buyers may exit abruptly, not gradually. The possibility introduces discontinuity into a market that depends on continuity. For China, the calculus is different. Losses incurred during exit are accepted as insurance premiums. Reserves are no longer optimized for return, but for resilience. The conversion of paper assets into physical inputs reflects a strategic shift away from abstract wealth toward material capacity. This shift is expensive in financial terms and rational in strategic terms. It prioritizes autonomy over efficiency. The philosophical implication is straightforward. Value is contextual. In a stable, integrated system, efficiency dominates. In a contested system, control dominates. Assets that generate yield but can be immobilized lose relevance. Assets that secure continuity under constraint gain relevance. This inversion explains why behaviors that appear irrational within one framework become logical within another. Markets often extrapolate the present into the future. They price trends as if they are permanent. Systemic transitions violate this habit. They unfold quietly until thresholds are crossed. China's drawdown does not force immediate repricing because substitution masks the pressure. When substitution reaches its limit, repricing accelerates. The lag between cause and effect creates complacency. That complacency is the risk. The $688 billion figure therefore functions as a marker. It does not predict timing, it signals trajectory. It indicates that one of the largest actors in the system has revised its assumptions about safety, alignment, and exposure. Others will adjust slowly or suddenly. The cumulative effect will be a system less reliant on a single reserve asset and more dependent on political cohesion. For individuals and institutions operating within this environment, the lesson is not to anticipate collapse, but to recognize transition. Systems in transition behave differently. Correlations shift. Hedging relationships weaken. Stability becomes conditional. Planning based on static assumptions becomes hazardous. The prudent response is not panic, but adaptation. History suggests that reserve transitions are resolved not by consensus, but by crisis. The catalyst is rarely the first mover. It is often the exhaustion of absorptive capacity among those propping up the old order. When that occurs, central banks intervene decisively. Currencies adjust, and new equilibria emerge. Those who anticipated the transition absorb the adjustment. Those who dismiss the signals are forced to react. China's behavior fits a long historical pattern. States preparing for uncertainty reduce reliance on external promises and increase control over tangible resources. They accept inefficiency today to avoid dependency tomorrow. This is not ideology. It is contingency planning at scale. The liquidation of U.S. Treasuries is the funding mechanism for that planning. The global system remains functional. Markets remain liquid. Headlines remain calm. That is how transitions look in their middle phase. The danger lies not in volatility, but in false stability. When stability is maintained through obligation rather than confidence, it is inherently fragile. The conclusion is neither alarmist nor reassuring. It is structural. The United States Treasury bond has become an arena where geopolitics and finance intersect directly. It is no longer insulated from strategic calculation. As more actors internalize this reality, behavior will continue to change. The process will be uneven, contested, and prolonged. The exit is not complete. The adjustment is not finished. The system is not broken. but the assumptions that sustained it are no longer universal. That alone is sufficient to alter outcomes over time. In such environments, those who track flows rather than narratives are better positioned to understand what comes next. The data does not shout. It accumulates. And once it converges, the conclusion becomes unavoidable.